debt to income ratio, or DTI. DTI is important to you because it allows you to plan for the income you'll need over a 2-year period for the home that you want. It also educates you about how non-housing debt you incur affects the amount of money you can borrow for a home. It also is going to allow you to approach a lender with realistic expectations about how much money you will be able to borrow for a home. Wikipedia says there are 2 kinds of debt to income ratio. The first type of debt to income ratio is the front end ratio. This includes everything that has to do with your mortgage. That's your principal, your interest, your mortgage insurance, your hazard insurance, your property taxes, any homeowners association fees. If you're in a manufactured home on a rented lot, it would also include the rental fee for the lot and any other locally assessed fees that have to do with home ownership. The second type of DTI is called the back end ratio. That includes the front end ratio and all other reoccurring debts that carry a balance over to the next month, including your credit cards, your vehicle payments, your student loan payments, child support, alimony, anything like that. So we have 2 types: front end, that's your mortgage only; back end, that's your mortgage with all your other recurring debt. The next thing we'll do is go to FHA's fact page. And here FHA states all the debt to income ratio qualifications that they have for their loan programs. The first 2 at the top, one is numbered, one is not, but they are essentially the same. The differences are that this particular one that is unnumbered is for credit scores between 500 and 579, or absolutely no credit score whatsoever. The second is numbered number 1, and it is for credit scores 580 and above. They're both 31% maximum DTI for the front end and 43% maximum DTI for the back end. This states that energy efficient homes may have the DTI ratio stretched to 33 and 45. The second numbered debt to income credit ratio is for a scenario that would go up to 37% debt to income ratio on the front end and 47% debt to income ratio on the back end. This scenario is going to require one of the following compensating factors. The first compensating factor is verified documented cash reserves of monthly mortgage payments equal to or exceeding 3 months if it's a 1 to 2 unit property, or 6 months if it's a 3 to 4 unit property. Also, the second compensating factor that's available to you is a minimal increase in housing payment, and that is described as a new monthly mortgage payment that does not exceed the current monthly housing payment by more than $100 or 5%, whichever is less, and that there is a documented 12-month housing payment history with no more than 1 30-day late payment. And in the case of a cash out refinance, they are requiring that all payments on the mortgage being refinanced were made within the month that they were due for the previous 12 months. The third condition on that compensating factor is if the borrower has no current housing payment, this may not be used as a compensating factor. And the third is residual income. I believe that's talking about a lottery payment out over the next 30 years, a jingle that you wrote for a commercial that every time the commercials air on TV that you get a little money for that. Or if you're a movie star, you made a movie and you get residual income on that, or a sitcom on TV, that type of compensating factor would be allowed. The third scenario here that's numbered is a 40% front end debt to income ratio and a 40% back end debt to income ratio. This is where there is no discretionary debt. And it's described here as that the borrower's housing payment is the only open account with an outstanding balance not paid off monthly. And it goes on to say that the credit report shows established credit lines in the borrower's name open for at least 6 months, and it states the borrower can document these accounts have been paid off in full monthly for at least the last 6 months. The fourth scenario allows for a 40% front end DTI and a 50% back end DTI. This requires two of the following compensating factors, and the first and the second are the same as the compensating factor details in the scenario number 2. And that is compensating factor 1, that you have verified documented cash reserves equal to or exceeding 3 months or 6 months of monthly mortgage payments, 3 for a 1 to 2 unit property, and 6 monthly payments for a 3 to 4 unit property. And then we have minimal increase in housing payment. The new total monthly mortgage payment does not exceed the current total monthly housing payment by more than $100 or 5%, whichever is less. And there is a documented 12-month housing payment history with no more than one 30-day late payment. And in cash out refinance transactions, all payments of the mortgage must have been made within the month due for the last 12 months. The third condition here is that this may not be used as a compensating factor if the borrower has no current housing payment. The third compensating factor allowed in scenario number 4 is significant additional income, that is overtime, bonuses, part-time or seasonal employment, not reflected in the effective income. And that has conditions on it, and that it must have been received for the last 1 year and will likely continue. And if it were included in the gross effective income, it is sufficient to reduce the qualifying ratios not more than 37% and 47%. The fourth compensating factor in scenario number 4 is residual income. And that is, again, where we talked about if you have a lottery payment that's going to last the rest of your life, or at least the length of the loan, you have made a movie and you're receiving residual income from that, or a jingle for a commercial that's aired and you get money every time it's aired. There is some type of TV show that you've made, or something like that. That's residual income. And you must have 2 of these compensating factors to qualify for scenario number 4. Okay, the next thing we're going to do is we're going to go to the whiteboard. Now let's do the math. Joe borrower qualifies for scenario number 2. So he is allowed a 47% back-end debt to income ratio. He has earned $7,000 gross monthly income over the last 2 years. His maximum allowed back-end debt to income ratio is 47% or 0.47. We're going to multiply that times 7,000. That's going to come out to $3,290 a month. His maximum allowed front-end debt to income ratio is 37% or 0.37. We'll multiply that times 7,000, which comes out to $2,590. In this scenario, Joe borrower could have monthly recurring debt less than or equal to the $3,290 minus the $2,590, or $700. Joe's monthly payments are an auto payment of $300, a credit card monthly payment of $25, and a personal loan with a payment of $50 a month. These monthly payments total $375. Now, considering a maximum front-end debt-to-income ratio of 37% or $2,590 and $375 worth of monthly recurring debt added together equaling $2,965, we divide the $2,965 by the $7,000 of gross monthly income, and we can conclude that Joe's back-end debt-to-income ratio will be $2,965 divided by the $7,000, which equals 42.3%, and is below the maximum threshold of 47% debt to income ratio. This makes Joe borrower at or below the maximum on both the front end debt to income ratio and the back end debt to income ratio. So we have a maximum of $2,590 for the front end debt to income ratio, which includes the principal, interest, taxes, insurance, also known as PITI, homeowners association fees if applicable, and lot fees if a manufactured home on a rented lot, condo fees, whatever else is assessed for the mortgage payment. Next thing we do is we take this information, search national average 30-year fixed rate. Here, the current national average for a 30-year fixed is 6.97% on March 17th of 2023. We're going to take that information. We're going to go to my website, scroll down. Here's a mortgage calculator. We're going to take the mortgage calculator. We're going to wipe out the principal amount of the loan. Now we're going to put in today's 30-year fixed average rate of 6.97%. And then we're going to enter the payment amount. And we hit calculate. And now we have the maximum allowed principal loan amount. The reason why we want to know this is because it doesn't matter if you're 18 years old, and it doesn't matter if you're 30 years old and you have two kids and you're married and you're looking for your first home. What you want to know is how much home you can afford with the income that you have. And armed with that knowledge, you can then go out and look to see what is the maximum amount that you can afford. We never want to go to maximum because there's always going to be some kind of Murphy's Law that we need to have a margin for. But this gives you an idea of what you can afford, and then you can start looking online at homes that are in this price range. It's a great idea because before you go to a realtor, you need to be pre-approved. You're going to have to come to a lender. They're going to have to get all your documents. They're going to have to get your pay. They're going to have to show you how much you can afford. And this just lets you know beforehand about an approximation of how much home you can afford before you start the process. It also allows you to plan. So if you know what kind of home you want, then you know what kind of income that you have to be making. And you know that you have to have that income over a 2-year period, and that you have to have the documentation to do it. And so DTI, that's debt to income ratio. Please give me a thumbs up, share the video if you learned anything, and give me a call if you have any questions or you're ready to start the home purchase process. Thank you.